Hi, good afternoon and good evening. Hello, good afternoon and good evening. We will be waiting for 2, 3 minutes so that more participants will join and then we'll start. Hello, everyone. I think we should start now. Ibrahim, you are with me?
Yes, Salman, how are you? I'm with you.
Okay. So I believe we should start now. The recording is started. And okay, at the start, I'll give a little bit background and then I'll hand over to you. Again, good evening and good afternoon, everyone. Um, Myself is Salman Hassan. I'm Regional Director of IFA and IPA, Institute of Financial Accountants and Institute of Public Accountants of Australia. I'm basically being the Regional Director of Saudi and Bahrain. Along with me, Muhammad Ibrahim is the presenter for the day. And the topic which we have chosen for the day is IFRS 15. It's not the particular, like generally IFRS 15. So we are going to touch very particularly only the construction contracts as per the IFRS 15 or under the interpretation of IFRS 15. Um, just to give you an early update or the update on the renewal for the Institute of Public Accountants, like the members who have registered through Institute of Public Accountants, their annual subscription would be due in June, which is after, like I can say, a month or so, it will start. The other good news for the people who are living in Saudi Arabia or who are doing the practice in Saudi Arabia is that we have previously we had registered the Institute of Public Accountants fellow membership with SOCPA. Now, recently, almost a month ago, we have got registered the Institute of Financial Accountants 2 grades, which is AFA, Associate Financial Accountant, as well as the FFA, Fellow Financial Accountant. Those has been registered with SOCPA, and based on that, the the applicant can also get SOCPA membership. I heard there was a one or two case where they were facing difficulty while registering with SOCPA, but whosoever is facing such difficulties, please keep me posted or let me know. Normally, I'm available on different forums, LinkedIn as well as on personally. I'm sending some WhatsApp broadcast to everyone, so you can contact me if you are facing some challenges while registering with SOCPA, so that we can resolve such matter with SOCPA. Um, just a very brief introduction of about our speaker. He will give his introduction in detail as well. But just to introduce himself, Ibrahim is, I can say many times he has presented the different topics on IFRS on this forum along with Institute of Financial Accountants. And he is having the accounting firm background. Currently, he's working as a group consolidation reporting manager in one of the construction or real estate developer company in Riyadh. So over to you, Ibrahim. And before that, if anyone has any question with regards to SOCPA registration or SOCPA related stuff, so please raise your hand and I can answer. Otherwise, we'll move on. Okay, so we have Ghassan or Amir. Yeah. So Ghassan, your mic is unmute, so you can talk. Ghassan, your mic is unmute if you would like to talk. Okay, I think. Okay, so just one request, please, everyone, if you can provide your real name in the like while registering, rather like mentioning Samsung or so, so that we can name you as well as while getting, your CPD certificate, it will help you to have real name on the certificate along with your email ID. Okay, so I think Ibrahim, you can start. Just you can give your introduction, then I'll display and control the slides for you. Thank you.
Okay, Salman, thank you for the introduction, and thank you IFA for giving me an opportunity to present this webinar today. I will try my best to give maximum input out of it. Okay, coming towards my introduction, I have a background. I am ex Deloitte. I have completed my articles from Deloitte. Then I have moved to RSM, and then I have moved to a very, if I don't know if people are living in Riyadh or not, but in Riyadh I am working with Al Muzaini Real Estate Developers, who are currently a giant real estate developer group in Riyadh and all over KSA as well. And I'm working as a group financial controller, come group consolidation and group reporting manager there. And through this experience of around 2.5 years, I have learned a lot about the construction activities, particularly in Middle East, and what are the major impacts of IFRS 15 on these construction elements, particularly in Middle East and also globally. What are the major impacts throughout this journey? I have learned a lot, and I will try to give maximum input here in this presentation, so all of you can also get the benefit out of it. So this was my introduction, and Salman, I think without wasting any time, let's start. If you can share the screen or display the slides so we can start with the presentation.
Yep. So I believe screen is visible to everyone. It's now full screen. Is it full screen for everyone?
No, it's not full screen, Salman.
Okay, just a second.
Meanwhile, everyone can reply on the chat box that everyone is able to hear clearly my voice or not.
Okay, give me a few more seconds. I have to adjust some settings for duplicates view. Now you can see the full screen.
Yes, Salman. I think it's fine now.
Okay, okay, yeah,
Okay, guys, let's just start. Salman, just move to the introduction slide.
okay. Introduction.
Okay, last time I have already provided, I think it's been 6 or 8 months before, I have provided the presentation of IFRS 15 before as well. So today I will be focusing on the construction side particularly, but all and over you can ask other questions relevant to IFRS 15. And if it is possible in this session, I will try to give all the answers, inshallah. So let's give you a brief introduction of the IFRS 15, and let me tell you that why it matters in the construction side. As you can see in this screen, now it's been a time that IFRS 15, that is revenue from contract with customer, has been introduced. Like if you have read the standards like 6 years 7 years before, there was no IFRS 15. There was IS 18, IS 11. There's a construction contract. There was IFRIC 13, that is loyalty program. There was IFRIC 15, that is real estate. There was IFRIC 18, that was transfer assets from customers. There was SIC 31, barter transactions. But however, IASB, who is the body of IFRS in particular, has has understand the concern of all these standards and the difficulties and complexities. So they have merged together and bring out on the one consolidated standard, that is IFRS 15. After IFRS 15, all these standards were no longer available now, and only IFRS 15 has been used to where to check, to recognize the revenue, to recognize the timing of the revenue, to recognize if the revenue is there or not, or if the revenue is belong to which party. Everything related to the contract with customers for revenue, contracts, contract asset, contract liability, you will find in IFRS 15. Okay, so let's. This was a brief, small introduction, and if you want any detailed introduction, you can Google it. It is very simple. Or if you want to know anything more particular related to IFRS 15 introduction, you, we can have a question at the question answer session. So Salman, let's move to the next slide. Salman, you with me?
Yes, yes. Sorry, I had to reshare.
Just need to click the button, I guess. So
Sorry, my PowerPoint just crashed. I have to run it again.
I won't mind if Salman, if you allow me, I can share the screen.
No, it's ready. Just a second.
Okay, okay.
I want you to focus on the content, basically. Okay, now is it visible?
Yes, it's visible. You just need to put into a slide.
Sure.
You
Yeah.
need to,
Okay.
yes,
Yeah. Okay.
you can move to the next slides.
Yes. Sorry. Okay. So this, sorry everyone.
No problem. Well, let's come towards the scope of IFRS 15. Okay. As we are currently here to have an insight to the IFRS 15, particularly to construction contracts, so we need to know that currently IFRS 15 is extremely important for the construction industry. Extremely important. Like, I don't know how many people are here from the Middle East areas. So everyone, I think, knows about NEOM projects, Red Sea projects. There are several projects, and you know, in the NEOM project there are several different construction contracts. Every construction contracts terms are different from each other, and because of the different of the terms in the contract, IFRS 15 comes into place, and because of the provisions of IFRS 15, every contract can be recognized differently based on the provisions explained in the IFRS 15. And that is why IFRS 15 is now extremely important for the current growing construction industry, particularly in Middle East and also globally all over the world. If I come to the scope of IFRS 15, currently IFRS 15 applies to all customer contracts except for the contracts which are specially mentioned by a separate accounting standards. Like for example, lease contract is covered under IFRS 16. So any lease related contracts is not covered by IFRS 15 because there is a separate accounting standard for that. Similarly, insurance and financial instrument, we have IFRS 17, IFRS 9, which do not fall under IFRS 15. Other than these three, all the customer contracts should fall in the IFRS 15. You don't need to think about, like for example, any contract in your company, revenue related contract in your company comes towards you, and you are thinking that okay, which standards will give me the guidance to record the revenue and the contract cost, liability, everything. You don't need to think about it. Just check it is a lease contract, insurance contract, or it is a financial instrument. If that contract does not relate to all of these three, you just need to go to IFRS 15, which will guide you the whole way. So let's move to the next slide. Okay, now everyone knows. I know this is very normal now. Everyone knows about IFRS 15. That IFRS 15 starts with the five-step model, and I don't want everyone to get bored because I know everyone knows now right now about the five-step model. Still, I will give some little information of all this five-step model, but we all need to understand, even for the construction contracts and even for any other customer contracts, the guidance of IFRS 15 is not possible if you don't go from step 1 to step 5, which is very important. So if you want to recognize any revenue, if you want to understand this contract is a valid contract and it falls into which revenue criteria, how you will record the cost, how you will record the revenue, how you will record the contract liability, at which time period this revenue needs to be recognized or it does not need to be recognized, either is a primary revenue stream or it is not a primary revenue stream. For all these questions for a particular contract, it is not possible if you don't go from step 1 to step 5. So you cannot jump towards the step 3 and tell me that okay, IFRS 15 is giving me guidance. It's not possible. For every contract, this five step model is very important. extremely important. And you everyone needs to understand that the importance of this five step model is very huge. That no contract, I have not seen any contract in my whole experience which is possible, or which is possible to understand the guidance without going from the step one. So let's start with the step one. I will give you small guidance for all the step one, inshallah, and you will know about it. Let's give you a brief introduction and then we'll go in detail with all step one criterias. Okay. Let's say step one. Step one is the identifying the contract with the customer. We need to identify the contract. Either the contract is exist or not exist, and what are the particular provisions in IFRS 15 is telling us about, like which contract is valid, which is not valid, and which goes under which way. Everything is available in the IFRS 15, and I will be going to give you the major chunks of this step one, inshallah, in the next slides. And the step after you understand that the contract is identified, is a valid contract, and what are whatever it is, everything is there, and the contract is valid, then you move towards step two. In step two, if the contract is valid, then you will identify what are the liabilities, what are the obligations, what are the responsibilities a, a seller needs to provide under a particular contract, which is very important. You need to understand what are the performance obligation. Here, IFRS 15 term the responsibilities, liabilities, services into a one term. That term name is performance obligation. Okay, so in the step two, after verifying that the contract, there is a contract with the customer, then you need to identify what are the performance obligations, the responsibilities, the liabilities, the services that needs to be performed under that contract. Then move towards the step three. Step three, after you identify the contract, and then you identify what are the performance obligations. Then in the step three, you will determine that as per the contract, what is the transaction price. The transaction price is for the whole contract. The transaction price is for particular performance obligation, and either there are, maybe in the contract there are several different variable prices were there. You need to identify, okay, this is a transaction price and this is not a transaction price, or this transaction price can be embedded into a whole transaction price, or this needs to be estimated. So there are too many questions which step 3 will give you the answers of it. After that, you will understand, okay, this will be the transaction price of my contract. In step one, you will identify, okay, this is a contract or not. If this is a contract, then in step two, you will identify the performance obligations, the liabilities, the services that needs to be performed in that contract. And then in step three, you will determine, okay, this is my transaction price. So in many times, a contract is not giving you exactly the exact number of the transaction price based on the provisions and the guidance mentioned in the IFRS 15 standards. You need to identify there are several elements which combining together and creating a particular transaction price. That is why if you read a contract and there is something written, okay, that for example, Mr. A has promised Mr. B to construct this building with a price of 70 million Saudi riyals. Okay, and if there is written that if Mr. B has completed this project in before 2 years, he will be getting a discount of 20%. And if Mr. B will complete this project before 1 year, he will be getting a discount of 50%. So there, if these type of terms, I'm just as an example, I'm telling you there is a bonus terms or there is something else. For example, there could be any refund terms or there could be any deferred payment terms. If this type of provisions are mentioned in the terms of the contract, instead of 70 million, then 70 million is a whole is not your transaction price. You need to understand there could be other variable considerations which need to be addressed to determine the transaction price of the contract, which we will inshallah understand and learn briefly in step 3 in the other slides, inshallah. Okay, so after determining the transaction price, then there's a step 4, which is the extremely important step of IFRS 15. Many of the students, particularly in the examination department, many of the finance managers sitting in their companies, normally, what, as per my experience throughout my journey, I have seen the first three steps, everyone, mashallah, everyone tries to complete it correctly. They identify the contract, they identify the performance obligation, even they embed the variable consideration, they determine the transaction price. But when and the step 4, they made errors, because step 4 is extremely important. Why it is important? Because in step 4 you need to understand how to allocate your transaction price to the performance obligation. Like for example, if there is a one performance obligation, only single performance obligation, then it is very simple. But if there are more than one performance obligation, then allocation of transaction price is not easy. We need to understand in the step 4, which we will inshallah learn today in step 4 slides. Let's move towards the step 5, which is the final, which give after allocation of the transaction price. Now in step 5 we need to identify either all the performance obligation we have, that performance obligation will be satisfied how, like over the period or point in time is either the performance obligation will be like in what manner. So we need to understand the manner in which the performance obligation is satisfied, and to identify or to understand the manner in which the performance obligation is satisfied, there are specific conditions mentioned in IFRS 15 which needs to be filled. And if they are filled, then IFRS 15 tells us, okay, if those conditions are filled, then the revenue should be recognized in this manner, or if it is not filled, then it is need to be recognized in this manner. And if this is recognized in this manner, you can use this method to recognize the revenue. So step 5 is also important as step 4 is important. So I think this was the brief introduction of the step 5, and I don't think if people have any questions about it. If there is a question, we can ask in later in question answer session, but I think we need to move to step 1. But if there is any particular question, if you think we need to add in this slide, you can ask me right now. I give all of you 1 minute. If no question will raise, then we can move to the next slide. Salman, I don't think there are other questions. I think we can move to the next slides, right?
Yeah, sure.
Okay. Okay, now I'll be defining in particular all the steps, because IFRS 15 is all about the steps. If you understand the steps, then it is nothing is difficult in IFRS 15. Okay, so let's start with step 1. I've tried in this presentation to prepare the trees, so it will be very easy for everyone to understand. And I have already tried to summarize in a manner which is easily easily understandable even for a layman who doesn't know anything about IFRS, inshallah. So let's start with step 1. Step 1, what is step 1? Step 1 is identifying the contract and construction. I am currently I want to give you all the examples related to construction contracts, and I will try to explain you all the steps, having in mind that we are currently working for a contract in construction in particular. Okay, but if you have any other question with any other contract, you can ask here, and Inshallah, I will try to give answers of that as well. So identifying the contract in custom contract in construction. Similarly, as with all contract, they need to meet some criteria that the contract should be approved by both the parties. Both the parties means the seller and the buyer. The rights and the payment terms, rights and responsibilities of both the parties, and the payment terms means that if the contract is for 1 year or 2 year, how the payment terms will be fall, like maybe there will be phases or there will be milestones, that if you will achieve this step you'll have 50% of the payment, if you will achieve this step you will have the 70% of the payment. So all these payment terms and the rights and obligations for both the parties should be clearly mentioned. If there is any ambiguity or any unconditional responsibilities or any contingent responsibilities means, for example, if it is written particular in the contract that if meanwhile in for example there's a construction contract of 2 years, and it is written in the contract, if in the 2 years there will be rain, 100 millimeter rain for 3 hours, then you will have the payment earlier than before. Like for any this is a condition to the contract which is not clear. It is an unclear condition because it's not a, you can say it's not a speculation contract or something. So that's why the rights, obligation, the payment terms should be clearly mentioned in the contract. If it is not mentioned, this means this contract is a void contract and we should not consider this a contract. And in the step one, it should be void, and we cannot go ahead to check what is happening in the contract. Third thing is the commercial substance. Okay, commercial. There should be a commercial substance. There should be commercial substance. You can say that in the contract should be saying that okay, construct the building. I will give you some money. So this is a commercial business happening uh, in the contract. So the contract should identify a product or a service against some consideration which is commercially viable. That's why, in the sense, it is said to be a commercial substance. The fourth one is the probable collection of the consideration. Like, okay, we know this. We know probable collection of the consideration means, right? Like for example, you are having a contract with a real estate developer, okay, and you are also a known company. You are having a contract with the developer to construct your house in 1 year time, and you will be having this amount of consideration, okay. So which confirms that okay, this economic benefit will flow to the entity. Okay, for example, you are having a contract, with Mr. A, who has zero experience in construction. Okay, but forget about this example. Probable collection of consideration means that a contract should identify that an economic benefit will flow to the entity. Means a contract should identify the, like, contract is already identifying the payment terms, but from the gist of the contract or from the terms of the contract, it should be clearly defined that okay, if you complete this project, you will having the amount of money, which basically a contract should state that economic benefits to the from the contract should be flow to the other party who is delivering services to the other party. Okay, so based on this, if all these types of criteria are met, this means there is a contract, there's a genuine contract, and we can move towards the step two. However, before going towards the step two, I want you guys to understand the contract modification. It's a very detailed topic in the IFRS 15 standards, which normally people don't read it, and it is important because in the next slides you need to if you don't know about it, it will be difficult for you to understand. For example, the contract is already made, it is identified, and you are already recording revenue by following all the five step models. Okay, suddenly there is some changes in the contract from the other party. So those changes in the contracts, you need to understand either those changes fall under the contract modification or not, or if this of and if these modifications are happened in which manner, and how you need to assess the contract, and how you need to check if the modification considered to be a separate contract, or there is no need to prepare a separate contract, the old contract should be continued. So you understand my saying, you understand this, that any changes subsequently after you identify revenue and have done all the five step model, any subsequent changes in the contract is a contract modification. But this contract modification needs to be treated how? Either a separate contract or the similar contract. So I have prepared a tree here. I'm going to read this tree and then I'll explain. If there is any question, you guys can ask me. Okay. Okay. See, uh, the changes means are additional goods, services in the contract modification are distinct. What does it mean? I'm going to explain here. Standard is asking, like contract modification means what? In the contract, maybe the customer is asking for you to give more goods, like they have promised. Mr. A has promised Mr. B to build a school. Okay, build a school on a land of 300 square meters. 300 square meters. Okay, but and the contract was agreed, terms and conditions, everything agreed. Okay, but after 1 month, Mr. B came and told them, no, Mr. A, please, I need to modify the contract. I need to modify the contract. I want you to construct the school not in 300 square meters but in 600 square meters. So this is a contract modification, right? But what standard is saying that are additional goods or additional services. Here in our case, these are the additional services. Contract is IFRS 15 is asking you, are the additional services in the contract modification is distinct? Distinct means is different from the one which has been agreed previously or not. See, if this is not if it is distinct, different, then we go to another step. But if it is not distinct, if it is not different, I mean, no, it is not distinct. It is the same services, just the area has been increased. So this means we don't need to create a separate contract. It's an existing contract. What is it? It is an existing contract. Okay. And if it is an existing contract, we need to use the catch-up adjustment. Catch-up adjustment, here it means that, for example, you have agreed for a consideration of 3 million real to construct a school in 300 square meters. Okay, so for to construct a school in 600 square meters, it will be 6 million reals or whatever you can agree different in a different price as well. But it is an existing contract unless the services you guys providing is distinct. For example, I'm going to give you another example right now. For example, Mr. A has asked Mr. B to construct a school and 300 square meters earlier, and subsequently there he's asking, no, Mr. A, please construct a school in 300 square meters, and I also want you to create a hostel beside the school in the other 300 square meters. Now, the services are construction, but before he wants to create a school, construct a school, but now he wants to construct a hostel. So now the services are different, right? Right? It's distinct, it's different. So if it is different, then standard is asking another question. Does consideration reflect standalone price of distinct goods and services or not? Like for example, initially Mr. A agreed with Mr. B to construct a school in 3 million Saudi riyals at a 300 square meter area. After 2 months, Mr. A come to Mr. B and ask him, no, please construct a school and a hostel in the 600 square meter at a price of 5 million Saudi riyals. Now, please concentrate. In this contract modification, Mr. B instruct Mr. A to construct a school and a hostel in a 600 square meter area with a consideration of 5 million. Now he has not mentioned and he has not agreed anything that okay, uh, that this area, this like school construction price will be different and hostel construction price is different. He just want you to construct everything in 5 million. And currently, as per this provisions, I don't think it is easy or it is easily possible for Mr. A to distinct the standalone price selling price of both these distinct services. Distinct services means construction of a school and construction of hostel is a distinct services currently. So if the standalone prices is not you're not able to distinct, so then you need to terminate the old contract and create a new contract. And you need to allocate allocation of consideration allocated to the remaining performance obligation. Consideration from the how you calculate, you can read in the slide that consideration allocated to the remaining performance obligation. For example, the first performance obligation was 3 million, right, to construct the school. Now he is modifying the contract. He's saying that construct school and hostel everything in 5 million, and you're not able to distinguish the standalone selling price into the distinct services. So you need to create a new contract, but how you will allocate the consideration is that consideration allocated to the remaining performance obligation is equals to consideration from the old contract not yet recognized. Like for example, you have not recognized any revenue, so this means 3 million is not recognized. 3 million was not recognized. Plus the consideration in the contract modification. Okay. Which is, for example, in 5 minus 3 is 2 million. So your total consideration will be 5 million for the new contract. I know it sounds a bit difficult, but for example, currently think that nothing, no construction was started. So you need to understand that if you're not able to distinct the standalone selling prices of both the construction services, then the whole project will be under one performance obligation and one under one price, that is 5 million. However, 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 if subsequently, for example, Mr. A tells to Mr. B that construct the school and the hostel in the 600 square meters for 5 million Saudi riyals. But Mr. B told him, I can do that, but you need to understand something that at which area you want to construct hostel and at which area you want to construct schools, and what will be the price per square meter for the construction of the school, and what will be the price for per square meter for the construction of uh, your hostel. And after this communication, it is decided under the contract that the school will be constructed at 350 square meters and the hostel will be constructed at 250 square meters, but the total consideration will be 5 million. So here, see, these are the two distinct services, right? In the distinct, and the area is also distinct, you can easily divide it. So the total area is 600 square meters, so you can easily divide 600 square meters into 5 million, that is the contract price. So whatever it is, like whatever it will be, then multiplied by the 350 square meters, which will be your standalone selling price for the service construction service to construct a school, and then per square meter multiply by the 250 square meters to calculate the standalone selling price of the construction of the hostel. I think I am able to convey the contract modification. I know it's a bit quickly, but in this small session, I can only give you this brief introduction. However, after the end of the session, if anyone wants to go in detail or want to understand anything, I'll be sharing my LinkedIn profile so anyone can contact me there. I think we need to move to the other slide because I think we already took a long time in this step one. Okay. Any question you can ask or raise hand right now. I will give you 1 minute, then we can move to the next slide.
I believe we can move to the next slide because
Yes.
if
Yes,
someone will
Salman.
have question, they will raise hand and they can put their question in the chat. So anytime you
No
can
problem.
raise your questions, please. Okay, so we are on the step two now.
Okay. Let's move to the step two. Step two is performance obligation, that is identifying the performance obligation. As I mentioned, the performance obligation, we need to understand in the contract that what are the responsibilities of the seller of the services or the goods. What are the responsibilities? Those responsibilities have been termed as performance obligation under IFRS 15. Okay. So normally a performance obligation is a promise to transfer a good or service to customer. Either that could be good or there could be construction service or there could be any other services. That is distinct. Very important. It should be distinct. If it is not distinct, everything is a one performance obligation. If there are distinct services, there are more than one performance obligation. Distinct means different. We'll go to the IFRS guidance and how you would understand either the services or good is different or not. We'll come to that point as well. So, performance obligation is a promise to transfer goods, service to a customer. Either there could be good service that is distinct and a series of distinct goods services that are substantially the same. In construction, there could be design service. Okay, there could be you can say engineering, plant related service, civil work service, or there could be trunky. Trunky means a ready to use delivery, that someone has asked you to construct a villa in such dimension and some elevation. You will construct and that will be ready to use for delivery for the others. So there could be different types of contract in construction, that is the distinct services. Okay. And if the performance obligations are not distinct, we need to combine those performance obligations into a single obligation. What does it mean here? Standard is saying that, for example, in a contract, there are different services mentioned. And if you can see, those different services are just the sentences, but in particular and in the logic, all are the similar services and they are not distinct with each other as per the guidance of IFRS 15. Then we need to combine all these services into a one single performance obligation instead of creating a different type of revenue streams. Okay, now come to what's the guidance of IFRS 15. What is distinct, right? What is distinct and what is not distinct? Like, okay, there is a two-step model, and I have created a tree here to understand, which will give, inshallah, everyone a very brief understanding that how can you understand that a performance obligation is distinct with the another or not. Okay, there's a two-step model. So let's start with the reading in the presentation. That number one, customer can benefit from goods or the services either on its own or together with other resources that are readily available to the customer. What does it mean? I'll explain you more. The customer can benefit from the services, the one to whom the services will be provided. If the customer is benefited by the services on its own, for example, customer told you this is my land, I want you to construct a building on this land. So this means customer will be benefit from the services you provide. Okay, and the other one is that and or standard is saying or here together with other resources that are readily available to the customer, or you are giving any services to the customer, like for example customer has given you a constructed building, he asked you to paint this building. Okay, so you are giving a benefit to the customer on its own land with using the other resources, right? So in particular, if customer can benefit from the goods and services directly, okay, yes. So this means this service or this good is separately identifiable. It's distinct within the context of the contract. It's distinct with the contract. However, IFRS has given you three conditions to understand if it is separately identifiable or not. Okay, if it is separately identifiable or not, like you will the definition of standard, that is customer can benefit from goods and services either on its own or together with other resources. It will be easily understand if you understand the three conditions stated here. Like what standard is saying here, that good or service is separately identifiable, that means distinct if it's not integrated with other goods services into a combined output. Anyone give me the example of this point if someone knows about it? Like it's not integrated with other goods and services into a combined output. Like for example, there is a service of painting the house, okay, and there's a service of using the cement and uh, cement and the blocks and construct a whole room, okay, and using of paint and other cement material to construct a floor ceiling. So there are three performance obligation you can see in the contract. Okay, but can anyone tell me, or working on all of these can give you a combined output, or there will be separate outputs? Because what I think, if you do all these services, this will be a combined output is a construction of a room. That's why all these services are not distinct. They are of a particular one performance obligation, that is the construction of a room using this. So here standard is saying that if it's not integrated with other goods and services into a combined output, if those services or goods or services or goods, anything under the contract is not integrated and it's not going to give you a combined single output, there will be separate identifiable output, then that services should be considered as distinct. The second condition is saying it doesn't significantly modify or customize other items. It doesn't significantly modify or customize the other items. For example, for example, there's a, for example, let's say, there's a construction contract, okay, and a customer, there's a performance obligation under a contract that to construct a door, to construct a door, okay. There's three performance obligation, for example, to construct a iron door, okay, and to do, and to place tiles in a room, and to construct a iron door for that room, and to paint that room, okay. Okay, for example, to construct a iron door, if you will change the size of the door as per the instruction of your customer, this will affect the number of tiles you will use to place in the room, or this will affect the number of the area on which you will do the painting services. If it is if it is it's going to affect it, then the installation of iron door is is a distinct performance obligation. Otherwise, customer has no issues either to increase the number of blocks or to increase the size of iron installation of the iron door. The customer has no issue with that. Customer at the end, customer wants his room to be installed with the room, painting and tiles. Then both of these three are a combined performance obligation. I just want you to understand that what does it mean by the standard here, that the services does not modify or customize the other services. If it is not doing that, then this is not a, then this is not a distinct performance obligation, it is a combined performance obligation. Third one, it's not highly independent or interrelated with other services. For example, here is also saying, like, for example, one service is dependent on the other services, one service is dependent on the other services, then that service is not a distinct service. Both of them combinedly one performance obligation. Like, for example, a customer wants you to construct the room, and in the construction of the room, he wants you to level the level the floor with high quality cement, and then put the tiles on it. Okay, so you cannot install the tiles in the room until you level the surface with the high quality cement. So both are interdependent with each other, and that's why both are one performance obligation instead of considering that a distinct performance obligation. However, it depends on the terms of the contract. After reading the terms of the contract, you need to open IFRS 15, read these three conditions, and then from your own understanding and logic, you can understand either this performance obligation is separately identifiable or not. And why it is important to identify all the performance obligation, either it is a separate or it's a combined performance obligation. Why? Because IFRS 15 is telling us that all the performance obligation needs can have a different revenue recognition criteria at the end when you go towards the step 5. You got my point? For example, a one performance obligation should be calculated based on a different standalone selling price as per IFRS 15, and should be recognized differently as per step 5 in the revenue recognition criteria. That is why it is very important to understand either how many performance obligations are there in a contract, to understand the nature of that performance obligation, because sometimes the performance obligation is a fixed nature service, sometimes it is a delivery service only, sometimes There's a service which needs to be completed over the time. So all those performance obligation needs to be assessed differently in the IFRS 15. That is why it is very important to identify the how many performance obligations are there in a contract. Okay, let's move towards the next slide and give me just 1 minute. I need to drink water. Okay, I'm back. Salman, can we move to the next slide? Now let's move towards the another slide, that is determination of the transaction price. In any construction contract or any other revenue contract, there is always a transaction price, a contract price, you can say that this is the price of a contract to do the services or to sell the goods, anything. What standard is saying? Let's read it. I just mentioned. I also create a tree here as well to understand. What is saying that transaction price is the amount of consideration an entity expects to be entitled to in exchange for goods or services. Very simple. What is transaction price? Transaction price is any amount, anything which as a consideration a seller is expecting from the buyer in exchange of the services he is going to perform, right? This is a transaction price. Transaction price can be affected by nature, timing, and amount of concession. It can be affected. Why? Let's read it here. Okay. The transaction, however, transaction price can be affected with many other aspect. What is it? We can I just let you know. To determine the transaction price, what IFRS 15 is telling us, it is IFRS 15 is guiding us that please consider three things, four things. Sorry, IFRS 15 is emphasizing us that whenever you determine the transaction price of any contract, construction contract or any other contract, any other revenue contract, you need to consider four aspects. Number one, either there is a significant financing component involved in the contract transaction price, either there are some non-cash benefits or not, either there is some consideration that is payable to the customer in later period or something, or there is a credit terms or something, or either there is only fixed consideration or there is also variable consideration like bonus, rebates, or discounts. So it is very important whenever you determine the transaction price, you need to consider four aspects. Either the transaction price includes the significant financing components, either it includes non-cash benefits, either it includes consideration payable to customer, or either there is a variable consideration involvement or not. Why? Very important. For example, number one, let's say significant financing component. What is significant financing component? Significant financing component is anything in the contract or a promise to give you consideration on a later date, for example, and that later date is more than 12 months, then it is a significant financing component. Any consideration, any promise for a consideration to be paid at a later date, which is more than 12 months, then there's a financing component involved. And if there is a financing component involved, then that price, that transaction price, which is subject to the financing component, need to be adjusted to its present value. That is, we need to discount that transaction price and calculate the present value of the transaction price at the current date current start date of the contract. Let's say, for example, there is a contract between Mr. A and Mr. B. Okay, Mr. A and Mr. B. That, for example, they are saying that, for example, for example, let's say Mr. A promised to sell his readily available villas to Mr. B. Mr. A promised to sell its readily available housing units, villas to Mr. B at a consideration of 50 million Saudi riyals. Okay, and there is a condition in the contract that he is gonna pay 30 million Saudi riyals now and 20 million Saudi riyals after 1.5 years. This means that in the transaction price, an element of 20 million Saudi riyals has a financing component involved. Why? Because it needs to be paid after 12 months. So for that 20 million, we need to use an incremental borrowing rate. We need to discount that 20 million to the current pricing date, whatever it is, and then 30 million plus the present value of 20 million will be the transaction price of that contract, not the 50 million. It could be 48 million, 47 million. So that's why consideration of financing component is very important whenever you read the contract. Extremely important. Let's come towards the next element, that is non-cash benefits. What are the non-cash benefits? Non-cash benefits here means that instead of paying the money against a service performed, a, a customer has agreed to give you a land swap, for example. So, how you will determine your selling price? IFRS 15 is telling you for this type of land swaps or non-cash benefits, you need to calculate the transaction price or you need to account it for its the fair value of the particular land swap. Or if, for example, I am not aware that everyone knows about IFRS 13 or not, that there are three levels of fair value: level 1, level 2, level 3. So, for example, the fair value is not easily determinable in the case, okay, then you need to agree with the current standalone selling price in the contract, whatever it is, if the fair value is not available. In normal cases, if this is a land swap like non-cash benefits, the fair value is normally available. But if the fair value in which is not possible, in 99% of the cases, it is not possible, that fair value is not available. Even if someone is giving you its private equity shares in a company instead of the consideration, you can use different fair value methods to calculate the fair value of the particular shares. So I'm just giving you an example. There could be non-cash benefits, and standard is telling you that for the non-cash benefits, the transaction price should be the fair value, not the amount, the contract value which is mentioned in the contract. For example, there's a contract. The contract is that Mr. A promised to the Mr. A promised to uh, let's say it's very easy now here. Normally in Middle East, particularly in KSA, there are I think you guys know about Ministry of Housing. For example, there are many land blanks in Saudi Arabia. Ministry of Housing wants to develop those lands. Okay, so Ministry of Housing has prepared a contract with any developer in KSA. Okay, and they told them to construct, or to, for example, to please develop the land. Develop the land means there's a raw land which has mountains, plateaus. So Ministry of Housing gives a contract to a real estate developer to please develop this land. First of all, they need to site level this land, remove the mountains, plane the land, do the road mapping there, need add the fence there, to the electric, construct the electricity tower, then just develop the land area completely. Okay, with the consideration of, for example, 900 million. Okay, that 900 million is basically what, because this the developer told them that the total construction price is a 700 million and our margin will be around 200 million, so the price is 900 million. That's what the contract says. But the Ministry of Housing told them, okay, if you will develop this land, instead of paying you the money, we will make you the owner of this land. Like in a good faith, so just Ministry of Housing wants to develop the raw land in the society so they can do this initiative. So in this case, as per IFRS 15, instead of determining the transaction price as 900 million, the developer needs to evaluate the value of the land at the inception date of the contract. It could be 600 million, it could be 1 billion, but whatever it's the fair value should be considered as a transaction price to calculate the revenue of the contract. I think now it's very clear that what is non-cash benefits in in this case, right? Coming to the consideration payable to the customer, consideration payable to the customer, it includes cash or extent expected to be paid to the customer, as well as credit or other items such as coupons or vouchers. For example, there could be this thing normally not in construction contract, but there could be anything in extra of the total contract price. There could be vouchers, coupons, whatever it in extra in the contract which is payable to the customer needs to be adjusted with the transaction price. The last is the variable consideration, which is very very important, very important. Variable consideration can be bonus, rebates, discount. At like in the first second slide I gave you the example that Mr. A, for example, Mr. A promised Mr. B to construct a building in 2 years' time, and Mr. B confirms in the contract that if it will construct the building before 2 years, it will they will give him a bonus of 20%. If it will construct the building before 1.5 years, then it will give a bonus of 30%. Whatever could be the criteria. Okay, so that bonus thing or this bonus element is a variable consideration which needs to be calculated, assessed, estimated, and needs to be adjusted in the transaction price. For this, standard is giving us two methods. One is expected value method, and the other one is single most likely outcome. Expected value method is basically you need to assess based, for example, this is a real estate developer. What is the historical trend of this developer, that in how much time, in how much average time normally a developer construct the building. Based on that, you can calculate the probability, and then you can calculate multiply the probability on the bonus amount, which could be possible. Like there's a probability of 5% that the real estate developer can construct the building before 1.5 years, and the probability 10%, the probability is 50% that the customer is the supplier, the developer can construct the building before 1.5 years, and the probability is 80% that the developer can construct the building before 20 years. Okay, so he needs to multiply the probability with the expected bonus, and then need to calculate the average bonus, which is the expected value method, then need to adjust it to the transaction price instead of using the single contract price of the contract. Okay, and single most likely outcome is based on the judgment and the high probability and the probability of a particular outcome. However, the variable considerations like bonus rebates can only be included and can only be adjusted into the transaction price unless it is highly probable. Highly probable means like more than 75% there is a probability. Otherwise, you don't need to adjust this into your transaction price. I hope the step three is clear to everyone, right? If there is no question, we can move towards the step four. Salman, can you tell me how much time is left? Like how much we can continue? I don't know, but I don't know if I have.
I think we have around 15 more minutes. Like normally we have 90-minute session.
Okay, okay. Let me do it. Then we can see that how far we can go. Okay,
Sure, sure. Yeah.
no problem. Because I also want everyone to participate as well, na? Like having a question answer session at the end as well. So let's
Yeah,
say
sure,
we
sure.
can close step four and then we can continue the other presentation maybe in the next time whenever IFA
Mm,
allows it. Okay.
sure.
So let's say step
Otherwise,
four
if you have
allocation.
just step five, other than step five, do you have any more content?
Yeah, there is more content and step five will take too much time. That's what I know.
Okay,
I think
sure,
it will take time because it's the important one.
sure.
Let's say allocation of transaction price. I already explained previously that it is a very important step in IFRS 15 currently. Extremely important as we have now identified the contract. We know how many performance obligations are there in the contract, and now we also understand how what will be the transaction price in the contract. Okay, so now there is a tree. This I have prepared a tree here. So let's read it and I'll explain you meanwhile what the IFRS 15 is basically guiding us. Whether standalone selling price of each performance obligation is directly observable or not. The same thing I told you before, like we know the performance obligation that there is a distinct performance, either there is a distinct performance obligation, there is not a distinct performance obligation. Now come towards the standard alone selling price of each performance obligation. We need to understand that a standalone selling price of each performance obligation is directly observable or not. For example, in the contract, it is separately, particularly stated differently that for this performance obligation, this is the price, this is performance obligation, this is the price. This means it is directly observable. If there is written that the total contract price or total transaction price which we have determined is 500 million Saudi riyals, and these are the performance obligation under it, this means this is not directly observable. Okay, for example, a contract is such that all the standard prices of all performance obligation are directly observable. Yes, then we need to allocate the transaction price to each performance obligation based on the relative standard selling prices. If there is a discount, we need to adjust that. We need to adjust them and then come towards the step five to recognize the revenue either point at a time or through over the period of time. Okay. The question comes when the stand-alone selling price of each performance obligation is not directly observable. What happens is that, like for example, if the stand-alone selling price are not observable, then we need to estimate the selling price, stand-alone selling price for each performance obligation. Here I mean, here I mean, there's a contract with customer A to customer B to construct a housing society. Okay, for a contract value of 500 million. And for example, there are several variable consideration element and blah blah blah. And after adjusting everything, you have determined the transaction price of 500 million as a whole to construct a housing society. And for example, let's say in this whole contract, there are several different provisions like they need the customer also need you to prepare to construct, you can say, roads, to install a power station into the society, to interlock the roads. Like interlock means installing some different types of bricks to create a pathway in the complete society, to fence the complete society, to construct a garden in the society. There are several different types of responsibilities, which in the step two you have identified some as a combined performance obligation and some as a separate performance obligation. For example, you also need to construct a mosque as part of the contract in the society as well. But however, there's a one single transaction price you have determined, that is 500 million for a whole housing society. So how you will know, or how you will allocate the specific standalone selling prices for specific performance obligation that is distinct, which you have identified in the step 2, as there is no observable standalone selling prices. In this case, IFRS 15 is telling you there are three approaches you can use. Three approaches you can use to estimate the selling prices of those performance obligation. The most used approach are the first two approaches, which is you can see clearly on your screens. Okay. Number one is the market assessment approach. Number one is the market assessment approach. That is prices and fair value of goods and services in the market. What does it mean? Like for example, you have assessed this is a separate performance obligation, and then you have assessed that what is the market value. Like if you go to the another real estate or a constructor or contracting company, how much they will charge for this particular services. Like for example, you have taken three quotation, and these average out these three quotation, you can consider it as a fair value of that particular performance obligations. So you have all the fair value of the performance obligation, and then you have the total transaction price. Then you what you can do, you can just apportion that total transaction price as per the total fair values you have assessed for the particular performance obligation. Based on that, you can allocate the total transaction price to your specific performance obligation. That is the market assessment approach. Okay, the second approach is the expected cost plus margin approach. One minute. Expected cost plus margin approach is very simple. Like you have identified this is a distinct performance obligation. Like for example, installation of power station in the society, construction of a mosque in the society, interlocking in the whole society, or installation of fence in the whole society, are you have considered, for example, a separate performance obligation, distinct performance obligation. And you have asked your engineer to tell you what are the estimated costs to complete those performance obligations. He has given you the estimated cost of those performance obligation. Okay, then you just need to add the margin to those performance obligation. And when you add the margin, you have the estimated selling standalone selling price of all those performance obligation. Then you can apportion that those fair value as the same which we have done in the first method to calculate the standalone selling price based on the one single transaction price which we have determined in the step 3. So this is the second method, that is expected cost plus margin method. The third one is residual approach. Residual approach, it doesn't normally doesn't no, normally the company doesn't use this approach normally. What is this? That is total transaction price less the sum of observable standalone selling price. Like you have a transaction price. Okay, for example, you have a transaction price and you have some performance obligation. Okay, you have some performance obligation for which you have available observable standalone selling price. So when you have minus all the observable standalone selling price, then you have left with an amount of transaction price which you need to apportion onto the remaining performance obligation. And you can see that it is only applicable if standalone selling price is highly variable or uncertain, which normally is not happening in the construction construction industry. Okay, one important thing I have right here is that discounts and variable consideration are allocated on a proportionate basis to all performance obligation, as already I mentioned, unless there is a observable evidence that the discount relates to one or more specific performance obligation, or variable consideration relates specifically to satisfy that performance obligation. Let me explain you. Let me give you an example here. That A company asked B company to construct a whole society of 500 million. B company reporting manager opens the guidance of IFRS 15. He has identified the contract and then he identifies separate distinct performance obligation under this particular construction of housing society contract of 500 million Saudi riyals. The reporting manager understands that there are several distinct performance obligations under the contract, which is construction of mosque, construction of health institution, construction of grocery stores, construction of you can say interlocking of the roads, installation of fans, installation of power stations. There are several performance obligations under the contract. The other company, the customer also mention a provision that if the housing society is completed before 5 years time, then there will be a bonus of 20%. That means he is gonna give extra 20%, uh, extra 20% in addition to the 500 million of transaction price if the housing society is constructed before the year of five before 5 years. Okay, or there could be another aspects or there could be another benefits related to bonus which will happen, then it will be born. Okay, so when allocating the bonus to all the performance obligations, standalone selling price, a reporting manager will assess that as per the contract, this bonus is applicable to the main primary area of the housing society or all the areas of the housing society. For example, this bonus is applicable to the mosque as well or not, to the fence as well or not, to the electricity station as well or not. For example, the electricity power station is dependent on the electricity company. Whenever they approve it, they can able to install it. It's not dependent on the ability of the construction company. So in this case, it is very logical that the bonus should not be applied to the standalone selling price of installation of power station. Okay, so whenever they are allocating the bonus to the standalone selling price of the performance obligation, they need to remove the standard selling price of installation of power station, and then they need to allocate proportionately the estimated bonus calculated as per the methods that defined in the IFRS 15 to all the other performance obligation. I hope you understand what I mean here. If there is any question, let me know. I don't know, Salman. I think if the time is left, we can move towards the question answer session, and the rest we can do next time in next session whenever IFA
So
allows us
no problem.
as
We
per the
can plan maybe in 4 week time again.
no
So
problem.
okay, so I think now we can have a Q&A. So anyone can raise their hands or you can type in the chat. So all the options are available. Q&A, you can click on the Q&A session and type the Q&A as well.
Or you can also give any feedback as well,
Yeah, sure.
that you like the presentation or you think we need to improve any part as well. You can give the feedback as well. Much appreciated.
Okay, so we have one hand raised. So let me go to the participants.
Thank you, CKLM.
Hmm.
Appreciated.
Okay, so this is Kosala. So he can talk. You are unmute.
Hello.
Yeah.
Hello,
Hello.
sir. Yeah. One short question. Now, this IFRS 15, which is applicable for construction, yeah, I have some understanding, but at the same time, I would like to know whether there is one IFRS 15 applicable for the manufacturing industry.
Yeah, yeah, it is applicable. See, in the start of the session, I told you, if the contract is related to leases, that is IFRS 16. If it is contract is related to insurance, or if the contract is related to financial instrument like financial asset, financial liability, then IFRS 15 is not available. Other than that, in every case, you IFRS 15 is the only standard will give you the guidance for it. And for the manufacturing, IFRS 15 is, is the blessing.
The recognition of revenue, is it similar to here or now? For example, just in case, if a manufacturer produces a large, say refrigeration unit, right, which is done on part basis. So is there any kind of, the revenue recognition, applicable for stage by stage manufacturing process?
Yes, yes. See, even in the manufacturing, you need to go through all the steps, okay? And the step five, you need to assess the condition. The step five will give you two methods: either to record the revenue point at a time, means right now, or to record the revenue over the period of time, like in the phases. It depends
Uh,
on the terms of the contract, and
I see.
there are three conditions that needs to be fulfilled,
Uh-huh.
which needs to be justified as per the terms of the contract, which if they are fulfilled, then you can use the over the period of time. Other than that, in any every cases, there's a point in time. And in manufacturing, 99% of the cases, as per my experience, I have done too much manufacturing clients. 99% of the cases, the revenue is recorded at a point in time, that is when the performance obligation, which we have understand in step 2, is satisfied. For example there's a contract by a customer to deliver a batch of 5,000. For example, there's a masala company, spices company, for okay, so there's a contract with the customer to get him to deliver him 5,000 batches of masala A and 5,000 batches of masala B, 5,000 batches of masala C. So there is a three performance obligation. that is delivering masala A 5,000 batches, second performance obligation, delivering masala B 5,000 batches, and the third performance obligation delivering masala C 5,000 batches. So whenever you deliver masala A 5,000 batches, first performance obligation is satisfied, and whatever the transaction price is there, you can record as revenue. It's like that, but it depends.
I see.
Manufacturing.
I see.
Currently, I have focused only on the construction. Otherwise, I would
Consumption.
have given you several
Yeah.
examples of manufacturing.
Yeah.
Manufacturing
Yeah.
is much, much vast scope than construction.
Ah, I see.
Okay.
Right.
So,
Right.
Kosala, if I
Okay.
add a
Thank
little
you.
bit more
Yes. Yes.
on
Thank
your
you.
thoughts,
Yeah. Yeah.
basically, let's say you are missing that the business is kind of refrigerators, I think, manufacturing. So there could be generally, right, manufacturing of refrigerators,
Yeah.
right?
All right. Yeah.
So
Yeah.
basically in this case, most of the revenue could be point in time generally, but we have to see the
Uh-huh.
contracts with your customers.
Mm.
So, and but there would be warranty or guarantee. So in that case, only that portion relating to warranty and guarantee could be recorded over the
Recognize.
period of warranty and guarantee. Otherwise, normally it would be point in time. And
I
again,
see.
depends on the terms and contracts of the customer with the customers.
I see. Right. 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 Okay. Thank you. Thank you.
You're
Okay,
welcome.
so the next one we have is Muhammad. So Muhammad, I unmute your speaker if you can please talk. Muhammad,
Mohammed
okay,
speaker is not
okay,
unmute. You can ask Zubaria Ijaz.
okay, okay. So I'm unmuting Zubaria. If you can please ask your question.
Hi, sir. Good evening. This is Zubaria. Actually, my
Yeah.
question is related to the contract. Suppose we are constructing, there is a contract between me and you for 500 million. Okay.
Okay.
And it is a single composite. Okay. Where the performance obligations are different. Now, as you stated, there are three methods where we can allocate it as per a market assessment approach. So, suppose when we are taking the fair value of one single performance obligation, it can exceed to suppose now current market value is exceeding up to 7 million. So my contract price is 5 million. So can I
Okay.
adjust that 2 million in addition to that contract, or
No, no,
we
no,
should
no.
be in the
No,
limit
no,
of
no.
that contract?
No, no, Zubaria. I think maybe I have not communicated or not explain the thing in a way which I want to. Let me explain you again. For example, let's say there are three performance obligation. Okay, performance obligation type A, performance obligation type B, performance obligation type 3. Okay, there are three, and the total transaction price is 10 million for say. Okay, the total transaction price is 10 million. When you assess the market value, performance obligation A market value is 5 million, performance obligation B market value is 3 million, and performance obligation C market value is 6 million. In a total, it becomes how much? 5 plus 3 plus 6, it is 14 million, right?
Yeah,
However, your transaction price is 10 million. This is what your question, right? I'm going to explain you right now.
yeah, same. Yes, go, you
Okay.
got it.
Okay. So let's say total fair value is 14 million. Okay. Okay.
Okay.
A portion percentage of performance obligation A is 5 divided by 14. What is it? If you can tell me, or I'll tell you. Whatever it is, 5 divided by 14. Okay.
Okay.
And the performance obligation 2 is 3 divided by 14.
Mm-hmm.
And the performance
Okay.
obligation 3 is C is 6 divided by 14. So there are 3 percentage. Then multiply that percentage to 10 million, and then you'll have that standalone transaction price of all three performance obligation, that is accumulating 10 million. This is just to assess, use the fair value to determine or to allocate the transaction price into your performance obligation. You get my point?
Within remains the 10 million, right?
Exactly, because you will not
Take the
have the
10
you.
million, but percentage will be allocated based on the fair market value.
Why? Because it is
Yes.
extremely logical. Extremely
Yeah,
logical.
I
Why?
got it. I
Because
got it. My question was only this much. So we have to remain within the contract price, but the percentage will be allocated as per the fair
fair
market
value.
value. Got it.
Exactly.
Got it.
This.
Got it.
Okay. Thank you.
Thank you so much.
You too.
Yes, the next is Muhammad. Muhammad, if you would like to speak.
Hi, absolutely fascinating presentation, first of all. My brief
Yeah.
question is about um, the long-term contracts with some
Okay.
complex performance obligations and variable considerations. I wonder how we tackle that when the contract is like incredibly long.
Okay. No problem. Okay. This is your question.
Yes,
That's
please.
it. Okay, Muhammad. See. Currently, the presentation is all about long-term construction contracts because construction contracts in 99% of cases are long term. Long term means more than 12 months, right? So, in particular, as I stated, the variable consideration, particularly, there could be bonus, there could be rebates, there could be refunds as well. Okay, so all these variable consideration we need to assess in the transaction price, but only when IFRS 15 gives us a very specific guidance. IFRS 15 use a specific word that if a variable consideration is highly probable, in the terms of IFRS, if it is saying that is highly probable means it is more than 75%. If your probability to fulfill a condition which is subject to a variable consideration, that is bonus, rebate, anything, if that condition is more than 75% probable, only then you need to go through all these steps and calculation to adjust the transaction price. Otherwise you don't need to adjust the transaction price. Now come to the question again, like for example there is a probability which is more than 75% to fulfill a condition. Like example, I already gave you the example. If you complete a long-term construction contract, instead of 5 years you have completed in 3 years, then you'll have a 20% bonus, and you have a 75, more than 75% of the probability to calculate that you will succeed this condition. Then for example the contract is of 500 million, and the 20% will be 500 multiplied by 20% is you can say uh, 10 million, right? It's around 10 million, I guess so. Yes, it's around 10 million. 10 million, whatever it is. For example, the bonus is 10 million. Okay. So what you will do, you will not, like, your transaction price at the start of date is not 510 million. It will be what? It will be, for example, your percentage of probability is 80%. So 10 million multiplied by 80%, that can be 8 million. So your current transaction price, instead of 500 million, it should be 510 million to calculate the revenue. But however, the revenue can be recorded in any method which we have not covered today, that is step 5. It could be over the period of time or could be point in time based on the conditions and the guidance, or if the conditions are satisfied as per the IFRS 15. Okay. Still, now I am gonna give you another example to, you know, to clear your confusion. For example, you have assessed the transaction price as 508 million, and after 3 years you didn't succeeded to deliver the project on time, and you'll not be able to get the bonus. Now what you will do? You don't need to do nothing. You don't need to do nothing. Like for example, you don't need to reassess the transaction price right now until the revenue you are recognizing is over the period of time. If the revenue you are recognizing is over the period of time, then after 3 years you have come to know that no, our company will not be able to complete this contract within the condition which is subject in the contract, and we will not be able to take the bonus benefit, then whatever revenue is left that is related to bonus transaction, you need to adjust after 3 years. This is another calculation. I hope I may have given you a brief answer. However, there is a detailed calculation. If we have a detailed classes or something, I can explain you that as well. Or you can directly connect me through my LinkedIn as well.
Thank you.
You're welcome.
And plus, I think there would be a financing component as well on the long-term contracts.
Yes, for sure, which we already explained in our slides
Yeah.
today.
Okay. So the next one, I think Kosala and Zubaria, I think they have again raised their hand. Do you have more questions?
I
If
think
I
they
will unmute. Okay, Zubaria, your mic is unmute.
Sir, actually now this session is not fully completed, so curiosity will remain for the for the fifth slides. So it was a very good session. So we would appreciate if you can please initiate another session and complete this with and also adding one practical examples where we can find out the figures how we can adjust this market price or variable or cost plus methods. So how that will be a practical implication, and it will really help for a practical situation in the market how we are facing this.
Mhm. Sure, we will try our best. And normally, the next session, normally it should have happened within 6 weeks. That is too long time because we have to advertise and we have to see our schedules and other webinars. So let me see if we can expedite the timeline. Expedite in a sense we can have a session early in 2-3 weeks time. Sure.
Yeah, sure. Okay. So, sir, when the next session will be there, so this four slides will be explained again, or it will be started from the fifth because now it will, break the go through.
We will. I think Ibrahim can better comment, but I think we can give a highlight and then we can move to the fifth one, I believe. But
Yes,
it
we can
depends on
do that.
Ibrahim.
In 15 minutes, we can just give a highlight of the 4 steps, and then we can jump towards the step 5. How the
Okay.
thing is
Thank you
that
so
it
much.
depends. It depends because every time different participant joins.
Yeah.
No, for this session we will wait because now we completed only four. So next, the final conclusion one should be there. So how we will conclude this one?
We understand for sure. So
Yeah,
let's say if
we
there's
will
another session, we can
advertise
do
accordingly.
like that.
Yeah, it was
Yeah.
very informative. Thank you, sir.
Thank you.
You're welcome.
Okay. I think Sala, if you have more thing to ask, you
This
are
is a
unmute.
small request as requested by another. I would just like to see this step 4, the slide, just to take a screenshot so that next day, we will have a fair idea of, what we are discussing and learning. So if you
I
can
think
just display the
I think
display the
Salman, you
fifth one,
can. I think you can give the show the all the participants all the remaining 4 slides. I guess so.
fifth one is the revenue
Possibly.
recognition.
Yes. You mean like this?
Yeah, no, this is
We
the fourth
have
one, fifth
more.
one.
Just
Fifth
this
one.
one
Yeah.
in a display manner. Salman, you can show
Yeah,
it
yeah,
in
that's
a
right.
display
Yes,
manner.
yes, yes. That's right. Just hold on for a second. Yeah, just hold on for a
Like
second,
this?
please. No, yeah,
Yes.
yeah, yeah. Just hold on for a second.
Okay.
Yeah,
Okay.
yeah, yeah. The camera is giving a problem.
No problem.
1 second, please.
Salman, if you can share my LinkedIn profile link to them so they can also with me as well.
Yeah, sure. We will add your profile link
Or you
on the
chat
website. Yep.
box. Okay.
Or chat box, fine. Just I have to stop share the screen then, or let me just see. Okay, so I have to log in the LinkedIn.
Okay,
Yes,
thank
okay.
you. Thank you very much. And thank you for the whole presentation. It was nice.
You're welcome. Thank you for the comments.
Okay. Okay, so we have more questions? Anyone, if you please? Okay, so I'm going to paste the link
You're pasting, or I can
in the
paste
chat.
whatever is possible. Okay.
Yeah, it's in the chat. Everyone has the link now, and you can contact Ibrahim. Just a second. Maybe no, this one.
I think Salman, I have shared another link. This
Yeah,
is more, I think. Okay.
yeah. Just a sec. Yep, I have to delete that one. Yeah, the second one, which is sent by Ibrahim, is the right one.
You can connect me directly to my LinkedIn profile as well. Okay.
Okay, so I think we don't have. I think let me see in the Q&A. We have any session. Okay, so the participants are asking about the recording. Recording will be shared through our IFA administrator. And the presentation, please hold your horses because we would be delivering you the full session, including the next one, which is depending for the a few slides. Then these slides will be shared. Otherwise, in a few days, today it's we are normally doing we are having a session over the weekend. So by mid of next week, this recording will be uploaded on the YouTube IFA YouTube channel, and you can have the recording, or you can refer this recording or complete session over there. So we'll get back to you on the like the part two of this webinar. We'll contact you through email or WhatsApp as usual, which we are doing, or through LinkedIn as well. Thank you so much, Ibrahim, for delivering this useful and meaningful session over the uh, contracts, construction contracts insights. And thank you so much, participant, for joining us today. Have a nice evening, and take care of yourself. Thank you.
Welcome, Salman. Thank you.